New government statistics say fewer than 36% of graduates from for-profit colleges repay federal loans. That compares with 54% at public universities. And it is all grist for the Obama administration's plan to tighten regulation of this industry. The data triggered a sell-off in for-profit education stocks yesterday. And our next guest says, I told you so. Robert Wetenhall of RBC Capital Markets is one of the most accurate analysts on education stocks, according to Bloomberg data. He is here with us this morning. Bob, dramatic news from the government yesterday. How much of a game changer is this for the for-profit education industry? You'd have to figure it is something of a game changer given the stock reactions yesterday.
Absolutely, Eric. We think the DOE data release on repayment rates for the sector on Friday afternoon have dramatic ramifications. If you lose access to federal funding, it potentially compromises the business model. Access to Title IV student loan programs is really the lifeblood in the industry. So this is a massive change in the sector.
So if you're an investor and you're looking potentially at investing in any of these stocks, or perhaps you're holding right now, what do you do?
Probably don't need to be in this space. We've been bearish on the group for a while. 3 reasons why we're skeptical. 1, the regulatory situation is essentially a black box. Nobody can understand what the DOE is doing. Second point is that fundamentals might be deteriorating on the enrollment side. And third, there's definitely a lack of institutional sponsorship given volatility in the sector. So we really see a bearish outlook for the group in the near term in terms of share price movement.
Well, these stocks have been under extraordinary pressure for quite some time. If you were holding right now, do you think that the risks are, so to speak, to the downside, i.e. you'd be better off getting out today rather than sitting around for a couple of months and waiting to see what happens?
Downside risks are too excessive at this juncture, and we lack the ability, and we believe everybody else do, to handicap the downside from the regulatory risk. Just as an example, Strayer had previously reported that would be in compliance with repayment rate rules put forward by the DOE. They gave themselves an A, estimating a 55% repayment rate. The actual number released by the DOE on Friday was 25%, which is a grade F. So there's a pretty material discrepancy that has dramatic ramifications for this company's status going forward.
Now, is that to say, though, that you'll take all of the stocks in this space, Apollo, ITT, Career Education, Corinthian, et cetera? I mean, you do have a sell on Corinthian, but would you make them all a sell at this point?
Like I said, we're bearish on the sector. If you are going to own an equity in the space, right now we like Grand Canyon. They got a grade of A+ on the repayment rate trend. It's the best small cap growth story, strong experienced management team, and a robust business model. We also think Capella, which sold off aggressively, actually is in the middle in terms of compliance with the repayment rate. Possibly some upside there. We're waiting to see what happens with Strayer. We've temporarily revoked our rating till we get greater clarity on the outcome with that situation.
Does this shift the debate from 90-10, the whole question as to whether these colleges were sourcing too much of their revenue from student loans?
Actually, it's related to it because, like I said, the lifeblood of the industry is built on continued access to having students obtain federal student loan programs. If a school becomes ineligible, it's really out of the business at that point. And that's why some of the stocks like Corinthian colleges are having so much trouble. Repayment rates were in the mid-20s for it versus a basic threshold of 35%.
Bob, with about 45 seconds to go, is this subprime part 2 a transfer of wealth to a private industry? Who ends up holding the bag? The taxpayers. These loans aren't getting paid off.
There's very negative repayment trends that you have to acknowledge if you look at the space with any scrutiny. So some of the things in Congress right now are trying to address that. The DOE is also making its own initiatives to address that. How that plays out, we're skeptical. We don't have the crystal ball at this juncture.
Is there a dollar figure? Can you ballpark how much taxpayers are going to end up having to pay or swallow as a result of this lack of repayment?
Wouldn't even begin to handicap that one.
All right. Bob Wetenhall of RBC Capital Markets, thank you very much for joining us.